Welcome to the online classroom for the module RSK4805, Market Risk. So we've been going through the classes for this module, and to date we've covered the first topic. So if you remember, the first topic is divided into 3 learning units. We've looked at, in the previous classes, we looked at an introduction, which is chapter 1. Then we looked at final institutions, chapters 2, 3, and 4. And we also covered regulation, in particular banking regulation, focused on the Basel Accords and regulation in banking. So those were some very important topics associated with regulation. So what I've actually decided to do, just to help you understand things better, I'm going to first take you through chapter 5 and chapters 8 to 9, 10 to 11. And then after chapter 5, I'm going to visit chapters 17 and 18 under regulation. I didn't think it would make sense for me to go over chapters 17 and chapters 18 because some of the concepts they talk about, you have to have a good understanding of chapter 5. So I'm first going to go through chapter 5, and then after going through chapter 5, I will come back to chapter 17, in which by then you should have a basic understanding of some of the concepts we'll be talking about, as well as chapter 18. So chapter 17 and 18, I'm only going to come back to these chapters once your background with regards to trading in financial markets, interest rate volatility and correlation, and value at risk. Once you're more comfortable with some of these technical concepts, I will go back to regulation under chapter 17 and 18 because some of those concepts won't make sense to you until you've covered these earlier chapters. And you notice that the textbook actually goes different parts of the book. Like it goes, first it's at the front, then it goes to the back, then back in the front. So it just touches everywhere. But I'm trying to introduce this to you in a sequential way that you understand. So we've looked at introduction, which is chapter 1. We've looked at chapters 2, 3, and 4, which is financial institutions. We've looked at chapters 15 and 16, which is under regulation. I'll now look at chapter 5, right? And I'll also look at chapters 8 to 9 and chapters 10 to 11. And then once you have a good understanding of these concepts covered here, I think only then I'll go back to chapters 17 and 18. Or even what I might do is I might cover chapters 5, 8 to 9, 10 to 11, maybe even 12 and 13, because there's a lot of value at risk also talked about in chapter 17 and 18. So I will go back to those chapters, but for now I've decided to put them aside so that your background with regards to some of the concepts used in risk management and finance and investments, just to make sure your background is a bit better. Okay, so we are going to continue going through the notes. Okay, there we go. So I'm going to take you through learning unit 4 from topic 2. In particular, we are going to look at chapter 5, trading in financial markets. So chapter 5 can be found in your prescribed textbook under chapter 5. So a lot of the concepts that I'm taking you through, if you don't fully understand them, you can just go through chapter 5 again And if you still don't understand, then you can let me know. So we're going to look at 8 key areas in this chapter. We'll look at the markets, the different types of financial markets that we have, where you can purchase or sell assets or financial instruments. We'll talk about what we call clearing houses, and then I'll take you through an example from one of the assignments on what a clearing house is. And then we'll talk about long and short positions in assets. These are all very important terms. And then lastly, we'll look at the derivatives market. So these are the 4 areas we're going to cover today. And then in the second class, part 2 on chapter 5, we will look at plain vanilla derivatives, the different types of derivatives we have and what a derivative is. Then we'll look at some examples from one of the assignments. Then we'll talk about non-traditional derivatives, exotic options and structured products, and risk management challenges. So for this class, we're just going to look at the markets, clearing houses, long and short positions in assets, and derivatives markets. So let's start with markets. So whenever you buy or sell a financial instrument or a financial asset, such as bonds, shares, you can conduct your trade in 2 types of markets. We have what we call exchange-traded markets, and we have what we call over-the-counter markets. So primarily, when we're looking at finance and investments, there are 2 types of markets that an investor can purchase financial instruments or sell financial instruments. And these markets are classified as exchange-traded markets and over-the-counter markets. Okay, so let's talk briefly about what exchange-traded markets are. So I'll read and then I'll explain. An exchange, meaning an exchange-traded market, refers to a central marketplace where financial securities are available to buy or sell. The role of the exchange is to define the contracts that trade, organize trading so that market participants can be sure that the trades they agree will be honored. Trades are now mostly done electronically, but in the past they were done using what we call an open outcry system. Okay, basically, when we talk about an exchange-traded market, we're talking about the Johannesburg Stock Exchange, for example. You'll find that at the Johannesburg Stock Exchange, we have a central market, right? And at the central market, buyers and sellers can trade in shares of different companies. So if you want to buy shares in a certain company, you can buy them at the Johannesburg Stock Exchange. And if you own shares in a certain companies which are listed, we say that a company is listed. If you can buy shares in that company or sell shares in that company, you can do so on the Johannesburg Stock Exchange. So usually you as an individual, you're not allowed to actually purchase or sell listed shares on the JSE. You usually purchase or sell the shares through a broker, Okay, so the Johannesburg Stock Exchange is an example of an exchange-traded market. We have a central marketplace where there are many buyers and sellers, and those buyers and sellers can purchase shares in certain companies or sell shares in certain companies. So the stock exchange, the Johannesburg Stock Exchange, defines the contracts. Like it will tell you these are shares in this company, these are shares in that company, and so forth. And they organize the trading. They display prices, the shares are selling at, the volume that's been sold. They make sure that everything is in order. Okay, and they make sure that if a person says they will buy, they will buy. And if a person says they will sell, they will sell. They make sure that the brokers who participate in the buying and selling of these shares will honor their agreements. Okay. So most of these trades are actually done electronically. As a broker or a trader, you don't actually have to be at the Johannesburg Stock Exchange. You can actually just participate in the market electronically through your computer, buying the shares online or selling them online and so forth. But in the past, people actually used to go to the exchange, not just the JSE. There's also the London Stock Exchange, the New York Stock Exchange. There are different stock exchanges in different companies. In the past, people did not actually buy or sell electronically through computers. They would actually go to the exchange and use what was known as an open outcry system. So let's briefly read on the open outcry system, and then again I will explain. Okay. So the meeting of individuals at the exchange in the trading pit and agreeing on the prices for trades using hand signals is the open outcry system. And then electronic trading involves traders entering their desired trades at a keyboard and a computer being used to match the buyers and sellers. So with the open outcry system, what you would have many buyers and sellers at the exchange, and they would be in what we call the trading pit, like somewhere in the middle of the exchange. And then they would be communicating with each other when they want to sell shares or when they want to buy shares, and they would be using hand signals, right? However, with the recent advent of computers, the open outcry system is still used in some countries, but very minimally. People now prefer to conduct their trades electronically rather than telling other individuals in the trading pit what they want to buy or what they want to sell. Individuals now just typing into their computer that they want to sell certain amounts of a share at a certain price, and then the exchange tries to match them with a willing seller at that price. Or if a trader wants to buy, they can simply enter into their keyboard that they want to buy, and the computer matches them with a seller who's prepared to sell at that price. So if you want to sell, the exchange will link you up with a buyer. If you want to buy, the exchange will link you up with a seller. Okay, so that's electronic trading. So these trades that people conducting can also sometimes be facilitated by very important individuals in the market known as market makers. Market makers are very important individuals in the market. They ensure liquidity. And by that we mean that market makers are individuals who are always prepared to quote a bid price and an offer price. Okay. In other words, market makers are always prepared to buy any shares that anyone is trying to sell on the exchange at their bidding price. So the market maker will say, I'm prepared to buy shares for this company at this price. So the price that they're prepared to buy shares at is known as the bid price. And the price they are prepared to sell shares at in a specific company is known as the offer price. So market makers are always prepared to quote a bid price for any share listed on the exchange. And they are always prepared to quote an offer price for any shares listed on the exchange. So this ensures that if you are a trader who wants to sell shares in a particular company, a market maker will always have a bid price, a price they're prepared to buy the share from you. Likewise, if you're an investor who wants to purchase shares in a certain company, market makers will always have an offer price, a price they are prepared to sell the share to you. So market makers make the market. They make sure that the market is always active and there's always liquidity in the market to purchase when people want to sell and to sell when people want to buy. So like I said, the bid price is the price that the market maker is prepared to buy at, and the offer price is the price that the market maker is prepared to sell at. So market makers are found in exchange traded markets. So it's also important to note that the difference between the bid price and the offer price is known as the spread, and it is the profit to the market maker. So for example, you might go to the JSE, and then your broker might talk to a market maker, and the market maker might tell you that if you want to invest in shares, let's say in MTN, the bid price is 210 Rand and the offer price is 218 Rand. This means if you want to sell shares in MTN, the market maker is prepared to buy those shares at 210 Rand. And if you want to sell shares in MTN, the market maker is prepared to buy them at 210. And then if you want to buy shares in MTN, the market maker is prepared to sell them at 218. So they make sure that a trade is always possible. And then the difference between the 218 and 210, which is 8 Rand, will be the profit to the market maker. There'll be other expenses like transaction costs, accounting costs, broker fees, and so forth. But this will be the general profit to the market maker. So whenever you see an exam on assignment question, you can see bid and offer. Remember, bid is the price that you can sell something at, and offer is the price that you can buy a financial security at. And almost always, the offer price will always be higher than the bid price. Almost always. The offer price will be higher than the bid price. Right. And then we have over-the-counter markets, which are the opposite of exchange-traded markets. So with over-the-counter markets, we have a huge network of traders who work for financial institutions, so again, I'll read and then explain. Large corporations or fund managers. It is used for trading many different products, including bonds, foreign currencies, and derivatives. We're going to talk a lot about what derivatives are. Banks are very active participants in the market and often act as market makers for the more commonly traded instruments. For example, most banks are prepared to provide bid and offer quotes on a range of different exchange rates. Okay, so remember, we said that with exchange traded markets, right? We have a market where we have a lot of buyers and sellers, and we have the exchange that makes sure that everything is conducted in an orderly manner. And the exchange makes sure that if you say you're going to buy, you honor your commitment. If you say you're going to sell, you honor your commitment. And the exchange also defines which contracts can be sold, and they monitor everything happening to make sure everything happens in an efficient and orderly manner. On the alternative, we have over-the-counter markets. Now, these are sort of like private markets, right? These are markets in which the buyer and the seller actually meet. If you look at an exchange-traded market, like you buying shares on the JSE or you selling shares on the JSE, you actually don't meet the seller. You don't meet the seller, right? You just type in what you want to buy on the keyboard, and then the exchange links you up with a seller, right? If you're a buyer or if you're a seller, it links you up with a buyer. Even if you use the open outcry system, the exchange facilitates the trade to link you up with the buyer and the seller. And then they make sure that the transaction occurs. They specify what can be sold, which companies can list on the exchange. However, on the over-the-counter markets, there's no regulation like that. It just involves two individuals sitting down, maybe a bank and a trader, and then talking about what they want to sell to each other and coming up with the appropriate terms. Usually banks are the counterparties. So if you want to buy foreign currency or some unique product, usually the bank will be prepared to sell to you if you want to buy, or they'll be prepared to buy from you if you want to sell. So it will be an arrangement between you and the bank, a private arrangement. So there are some advantages to over-the-counter markets. a key advantage of the over-the-counter market is that the terms of the contract do not have to be those specified by the exchange. Remember, we said that with exchange-traded markets, the exchange specifies what can be sold, how it can be sold, and so forth. But with over-the-counter markets, anything can go. Anything, private companies, derivatives, currencies. It's not just certain products like the exchange-traded markets. Market participants are free to negotiate any mutually attractive deal. With over-the-counter markets, you can actually sit down with the buyer if you're a seller, and you can actually talk about how you want to tailor the deal to meet your own needs and the needs of the buyer or the seller. So the exchange isn't the one that's forcing you to adhere to certain regulations when you are selling your asset. It's just you and the buyer talking to each other, maybe through phone conversations, and then you record the phone conversation, and then you agree what you're going to pay or what you're going to receive. There might be lawyers involved, you sign documents. So it's a private sale. It's a marketplace where buyers and sellers meet privately to conduct their business. They don't have to meet physically. It can also be through the phone or electronically, but you have direct communication with the buyer or the seller, unlike the exchange where you are buying or selling through an exchange and you've got no way to actually deal with the buyer or seller. So trades in the over-the-counter market are typically much larger than trades in the exchange-traded market. So you might see an over-the-counter arrangement to sell currencies or bonds might involve millions and millions or even billions, whereas for exchange-traded markets, the volume or the monetary amount is likely to be less. So because of the high amount of the transactions are specialized. Okay. So next I want us to talk about, so we've looked at the first part, right? The markets. We said we've got exchange-traded markets, over-the-counter markets. We've explained the difference between those two. Next, we want to talk about clearinghouses. Clearinghouses are a very important part of exchange-traded markets, right? So I'll read again and then I'll explain. I'll read and explain. So exchange-traded derivatives contracts are administered by a clearinghouse. The clearinghouse has a number of members, and trades by non-members have to be channeled through the members for clearing. And the members of the clearinghouse contribute to the guarantee fund that is managed by the clearinghouse. Okay, so let me just explain this. So with regards to any exchange, we have a very important financial institution known as a clearinghouse. Very, very important financial institution. Okay. And the clearinghouse is responsible for administering some very important financial contracts called derivatives. So we've talked about two keywords here. Word number one is clearinghouse. Word number two is derivatives. A clearinghouse is a very important financial institution which is part of the exchange in an exchange-traded market. And the clearinghouse is responsible for the purchase and sale of financial contracts known as derivatives. Okay. We're going to talk about what derivatives are, but I'll give you a simple example of one type of derivative that the clearinghouse is responsible for. But we're going to talk about this later on. The clearinghouse is responsible for the administration of a derivative contract known as a futures contract. The clearinghouse is responsible for a derivatives contract known as a futures contract. So what is a futures contract? Okay, so a futures contract is just an agreement. It's an agreement. It's a legal agreement, so you are obliged. It's an agreement to buy or sell a given asset on a given date at an agreed price. Okay. A futures contract is just a special type of contract, which is an agreement to buy or sell a given asset on a given date at an agreed price. For example, let's say I'm a farmer and I farm potatoes. And then let's say I sell these potatoes. Let's say I farm these potatoes in August, and then I sell them in August, right? To chip manufacturers. People who make fresh chips or just chips, those chips like Lay's and so forth. So let's say I'm a farmer, I manufacture potatoes in August, and I sell those potatoes to companies that make chips, right? And then let's say I'm afraid that come August, when it's time to sell my potatoes, the price of potatoes might have gone down. The prices of potatoes per kg might have gone down. So let's say currently the prices per kg of potatoes, let's say it's 20 Rand per kg, right? But let's say I'm afraid that come August, when it's time to sell these potatoes, let's say I'm afraid that maybe the price will be 15 Rand per kg, which might mean I end up making less than I would make if I had the potatoes today, right? So what I can do, I can go to an exchange. I can go to an exchange and I can approach the clearinghouse. And then I can say to the clearinghouse, look, I'm looking to enter into an agreement with someone such that that person will agree to buy my potatoes, which are the given assets. Someone will agree to buy my potatoes in August, which is the date, in August. Someone will agree to buy my potatoes at a given price in August, right? Someone will agree to buy my potatoes, which is the asset, in August at um, at 18 Rand per kg. So let's say this is the price that the exchange will tell you that, look, yes, we can find someone to buy your potatoes, in August. But the price that's working in the market is 18 Rand per kg. Okay. So what you would then do, you would then say, it's fine. I want to enter into this agreement because at least I'm guaranteed to receive 18 Rand per kg on my potatoes in August. That means even if the market price falls to 15 Rand in August, you are guaranteed to receive 18 kgs per Rand because the clearinghouse has matched you with the buyer. You're prepared to sell at this price in August, and the buyer is prepared to buy at this price in August, right? So the clearinghouse will have entered you into a futures contract, which guarantees the price that you can sell your potatoes at. So even if the price in the market goes down in August, you're not affected by this. You are guaranteed 18. If the price goes up, it's also to your disadvantage now because you'll still be receiving 18 whilst other people might be receiving 21 or 22 or 20. So a futures contract, even though it protects you from the downside, it means that any upside benefits will be gone. So that's an example of a derivative contract known as a futures contract. So an exchange is responsible for that whole process of matching you with the buyer or the seller. You won't see the buyer or seller, you'll just deal with the clearinghouse. So the clearinghouse is responsible for the administration of futures contracts. Okay. So since you won't actually be able to even deal with the clearinghouse directly, you have to go through a broker known as a member, and then the member is the one that will be responsible for the trade. So you might have to pay that member a small amount of money. So the clearinghouse is in effect actually saying, come August, just as an example, come August, I, as the clearinghouse, guarantee to buy the potatoes at 18 Rand per kg. But on the opposite side, they will have met a buyer. So this is how it works. Let me just show you. The clearinghouse is in the middle. They are the exchange, right? So this side, there'll be a buyer, someone who's prepared to buy your asset. And this side will be you. Let's say you're the seller. You're prepared to sell your asset. So the clearinghouse will say to the buyer, you as the buyer will give me money, right? And the clearinghouse will say to the seller, you as the seller will give me the asset. So you as the seller and you as the buyer, you never meet. As far as you're concerned, if you're a buyer, you're buying from the clearinghouse. And as far as you're concerned, if you're the seller, you're selling to the clearinghouse. So the clearinghouse is the intermediary. And what the clearinghouse will do, the clearinghouse will have some funds of money known as a guarantee fund in case when it's time for the seller to sell the asset, the buyer doesn't have money, the clearinghouse will make sure they have money in a guarantee fund to meet the purchase of the asset. Likewise, if the seller doesn't have the asset and the buyer wants to buy, the clearinghouse will use the guarantee fund to make sure they have the asset to meet the needs of the buyer. And then there's also another process that the clearinghouse does to make sure that the seller and the buyer both meet their sides of the agreement. So I now want to talk about that process. That process is known as marking to market. It's known as marking to market. It's a very important process known as marking to market. So I'm going to explain the process of marking to market by just reading through this paragraph, what marking to market is. Okay, so the first part says a clearinghouse ensures that default risk is eliminated from a futures contract. And like I was saying before, default risk is the risk that one of the parties in the futures contract won't honor their side of the obligation. So by acting as the counterparty, when the clearinghouse is in the middle, they ensure that the risk of default is eliminated, right? And then a clearinghouse, this is a financial institution that acts as an intermediary between the two parties that enter into a futures contract via the exchange. And then, so the way this default risk is also removed is through the process known as marking to market, like I was saying. So the way this happens is that when an investor enters into a futures contract, they are required to deposit what we call an initial margin. So let's say I approach the exchange and I want to sell my potatoes in a certain number of months. Or let's say another party approaches the exchange and they want to buy potatoes at a certain price in a certain number of months. Both of us will be required to deposit a certain amount of money with the clearinghouse known as an initial margin. It's sort of like a deposit on the transaction to make sure that we are agreeing or giving security that we will honor our side of the futures contract. And then this money, known as the initial margin, is deposited into an account known as a margin account. So every party who enters into a futures contract has to do so by depositing an initial margin, which is put into a margin account. So what happens is, as the futures contract gains or loses value, money is taken out or put into the margin account of the investor. Okay, as the futures contract gains or loses value, money is taken out or put into the margin account of the investor. So again, I need to explain this. So suppose that as an investor, we agreed at 18 Rand per kg, right? We agreed at 18 Rand per kg for my potatoes come August. So that would mean August potatoes at the exchange are operating at a price of 18 Rand. So I am the seller, right? And there's also a buyer. There's also someone who's agreed to buy these potatoes at 18 Rand per kg. And the clearinghouse is the intermediary. So I will sell to the clearinghouse. The buyer will buy from the clearinghouse. So this is at the beginning. Let's say after 1 day, the price of August potatoes per kg goes down to 17 Rand. Let's say after 1 day, after entering into the contract for 1 day, the price to actually buy or sell potatoes in August goes down to 17 Rand per kg. So this would be an advantage to me as the seller, right? Because I've already locked in 18. I can always sell at 18 come August. So it would be an advantage to me as the seller. So what will happen? My margin account will get deposited 1 Rand. That account that I created at the clearinghouse will get deposited 1 Rand, which is the difference between the 18 and the 17. And then the buyer, remember the buyer agreed to buy at 18. If on the next day the price goes down, the buyer still has to buy at 18, whereas everyone else is buying at 17. So that's a disadvantage to the buyer. So the buyer will lose 1 Rand from their margin account. So that's what I mean here. As the futures contract gains or loses value, money is taken out or put into the margin account of the investor. So if you are a seller, you want the futures price to go down. And if you are a buyer, you want the futures price to go up, because you're going to be buying at a fixed price where everyone else is buying at a higher price. Whereas if you're the seller, you want the futures price to go down, because you're going to be selling at an already fixed price whilst everyone else is selling at a reduced price. Okay. So if the money in that margin account falls below a minimum known as the maintenance margin, so every buyer or seller's account should always have a minimum amount of money. And that minimum amount of money is known as the maintenance margin. So if the money in that account falls below the maintenance margin, the investor, the counterparty in the futures contract, whether they're the buyer or the seller, is requested to redeposit money to bring the account back up to the initial margin amount. Remember, we said at the beginning, an initial margin is deposited into the margin account. So the money is required to take it back up to the initial margin amount. So this amount of money that you have to put in, should your balance fall below the maintenance margin amount, is known as a variation margin. So we can look at that example again. Let's say I've agreed to sell my potatoes at 18 Rand per kg in August. And let's say the clearinghouse says, if for you to enter into this contract, we require an initial margin, a deposit of 5 Rand. You need to put 5 Rand per kg into your account, and the maintenance, the minimum amount of money you can have in your account is 2 Rand. Okay, so this is the maintenance margin, and then 5 Rand is the initial margin, right? So let's say this is what the exchange tells me. So as this price goes up and it goes down, money is put into my account and money is taken out. So if the money is taken out becomes so large that the margin account falls below 2 Rand, right? Just as an example, I will then receive what's known as a margin call. I'll be required to deposit money to bring my account back up to the initial margin. So the margin account, it's sort of like a bank account that acts as a deposit to make sure you will honor your agreement in the transaction. And the money in that bank account, the money you initially put in is known as the initial margin. And the balance in that account should never go below the maintenance margin. If it goes below what we call the maintenance margin, you will be required to deposit money to bring your account back up to the initial margin amount. And the difference between, and the amount of money that you have to put back to bring the account back up to the initial margin amount is known as the variation margin. So when the balance in the account goes below the maintenance margin, we say that the investor receives a margin call. So if the futures price, let's say you are a seller and the futures price starts going up, and it keeps, remember, the going up of a futures price is a disadvantage to you. You want to sell at 18 Rand per kg in August. Let's say the next day the futures price actually goes to 25 Rand per kg in August. You would be at a disadvantage because you have locked in 18 Rand for August, but everyone else who's coming a day later is getting 25 Rand per kg. So this would mean you are at a disadvantage. So the clearinghouse would take 7 Rand out of your margin account. So if initially your account at 5 Rand and the maintenance margin was 2 Rand, it would mean that the balance in your account would go below 2 Rand, and then you would get a margin call. The clearinghouse would require, you had 5 Rand initially, they would take all of the 5 Rand to cover the 7 Rand loss, and then they would require another 2 Rand from you, and then they would require you to deposit 5 Rand again to take your account back up to the initial margin. So we're going to look at an example on that from one of the assignments coming up next. So some futures contracts impose limits on the price change that can occur from one day to the next day. This is called price limits. Sometimes the prices of futures contracts can change very significantly in a given day. So you'll find that some clearinghouses, to try to make sure that futures contracts don't change too much in price, resulting in excessive losses or gains, they might have price limits. For example, using my example on potatoes, the clearinghouse might say the price limit is 10 Rand, right? The price limit is 10 Rand, meaning on any given day, if the futures price rises by 10 Rand to 28 Rand per kg, or falls by 10 Rand to 8 Rand per kg, then we stop trading. We stop trading just to avoid excessive gains or losses to the parties involved. So those are known as price limits. So I now want to take you through an example to illustrate how a futures contract actually works. Now you should be familiar with some of these words. You should be familiar with what we mean by a futures contract. It's just an agreement to sell an asset at an agreed price on an agreed date. So this is an investor enters into a futures contract to sell white maize for 3,700 per ton. So this is guaranteed sometime in the future. The contract is for delivery of 1,000 tons. The initial margin is 550,000. So the deposit on the transaction, the amount that the investor has to deposit with the clearinghouse into the margin account is 550,000. And their account has to maintain a minimum of 250,000. So remember, each day, money will be taken out of the account of the investor and money will be put into the account of the investor depending on the movement of the futures price. So this investor wants to sell white maize. So for them, it's a disadvantage if the futures price goes up, and it's an advantage if the futures price goes down, because they are guaranteed 3,700. So if prices go down, they'll be receiving 3,700, whereas everyone else will be receiving something lower. And if prices go up, they'll be at a disadvantage because they'll be receiving 3,700, whereas everyone else is receiving something higher, right? So let's answer the first part. So the investor will make a profit or loss at the end of the contract if the price of white maize is 3,620. So let's say that at the end, the actual price of the maize ends up being 3,620, right? Whereas the investor has a contract where they can sell it for 3,700. Clearly, we can see that the investor is at an advantage. Remember what I say, if prices go down below what you agreed to sell at, it's an advantage to you because you can sell for 3,700, whereas everyone else can only sell for 3,620. So the investor will make a profit. The investor will make a profit. Okay. This is a profit because the investor entered into the contract to sell maize, and the price at the end of the contract is less than the price originally entered into. Remember, if you're looking at a futures contract, if the futures price goes down on the next day, you are benefiting if you entered to sell. Likewise, if at the end of the contract, the actual price of the maize is less than the price you entered into, you are at an advantage, so you make a profit. Okay, you are going to be selling for 3,700, whereas everyone else can only sell for 3,620. Then number two, what is the actual amount of profit or loss that the investor makes on this contract? To get the profit, the investor is going to be selling for 3,700, whereas everyone else is selling for 3,620. So the profit will simply be the futures price that the investor can sell at minus the price that everyone else can sell at times 1,000. We multiply by 1,000 because it's a contract on 1,000 tons, and 3,700 and 3,620 are prices per ton. So we get 80,000 Rand. So the profit is going to be an 80,000 Rand profit, right? So this investor can basically just go buy the maize for 3,620 in the market, then they can sell it on their futures contract for 3,700. So this 3,700 is a futures price, it's guaranteed. That's the price the investor will sell it, irregardless of what's happening in the market. It's a way of managing risk. Okay, so the profit would simply be the difference between these two times 1,000. Question number three. So now let's assume, question number three. Let's assume that the price is now actually 3,920. Now it's actually up. Remember, we said if the futures price goes up above the price you entered into, if you're selling, it's a disadvantage. Right? Likewise, if at the end of the contract, the actual price of the asset has gone up relative to the price you entered into and you're selling, it's a disadvantage, right? Because you're going to be selling for 3,700, whereas everyone else can sell for 3,920. So that means you will make a loss. This will be a loss. And then the exact amount of the loss. So yeah, I just said, this is a loss because the investor entered into the contract to sell maize, and the price at the end of the contract is more than the price originally entered into. So this is a loss because the investor entered into a contract to sell maize, and the price at the end of the contract is more than the price originally entered into. In other words, you've agreed to sell for 3,700, whereas everyone else can sell for 3,920. So you are legally obliged to sell at this price. So you'll be making a loss compared to what you would sell at in the market. So your loss will be 3,920 minus 3,700 times 1,000, because these are prices per ton, and we get 220,000. So there will be a loss of 220,000 Rand. So those are some examples of calculations involving futures contracts. Another common question, it wasn't asked here, is you could have been asked this, it's important. What fall in price, what fall in the futures price fall in futures price would lead to a margin call. Actually, what rise? Remember, we are selling. We are selling. So if we are selling, we don't want a rise in price because we are guaranteed to get 3,700. So if the price goes up to 4,000, we are at a disadvantage because we have to sell at 3,700, whereas other people can get 4,000 in the market. So if the price rises, some money will be taken out of our account because we'll be making a loss. But what amount of money needs to be, what rise in the futures price will lead to so much money being taken out of our account such that we go below the maintenance margin. Okay, it's just something I want you to understand. So remember, we've got the initial margin, which is the deposit we put into our futures contract. We've been told that 550,000 is put into the initial margin. So this is for 1,000 tons. So we can divide this by 1,000 and we get 550. So the initial margin is 550 per ton, right? So this is the amount of money we put into our margin account per ton. And then the maintenance margin is 250,000, right, for 1,000 tons. So we can divide this by 1,000 tons to get 250 per ton. So for each ton, the amount of money in our account should never fall below 250. And the initial amount we deposit is 550, right? So the difference between the initial margin and the maintenance margin is 300, right? So that's the difference between the initial margin, the money we deposit into the account, and the maintenance margin, the minimum maintenance amount we should keep in our account. So this 300 is sort of like a cushion. It's sort of like a cushion to protect us against rises in price and to protect the clearinghouse against rises in price in case we fail to honor our side of the agreement. So should this 3,700 tons rise by 300 to 4,000, it means that all the money in the deposit account will be taken. It means that the price of the futures contract will have risen so high, all of the money in the deposit account is taken. This all 300 will be taken. So if the futures price rises above 4,000, it means we will receive a margin call. It means that the money in our account will be completely taken out and we will need to redeposit money into the account. Okay. So remember, if you're selling, you don't want the price to rise. So a rise to price leads to money being taken out of your account. However, if you were buying, you don't want the price to fall. So any fall in price will lead to money being taken out of your margin account. In this case, we are selling, so we don't want the price to rise. So if the price rises, some money is taken out of our margin account. But if the price rises above 4,000, it means the funds in our account will go below 250. So all of this 300 will be taken out of our account, and then we will receive a margin call to redeposit that money. We'll look at more examples from assignments and other past papers as we get closer to the exam, but I hope you now have an understanding of what an initial margin is, what a maintenance margin is, and how the futures price, the price of a futures contract, how you can do calculations. Okay. So lastly, I just want to talk about long and short positions in assets and also derivatives markets. Again, I'll read and then explain. If an investor has a long position in an asset, It means that the investor has bought and owns the asset. So please note, we're going to talk about long and short positions in derivatives, right? We have long and short positions in derivatives or in the derivatives market. Yeah, I'm talking about long and short positions in the spot market, or long and short positions in the asset market, in the spot market. So if you have a long position in an asset, it means that you own the asset. A long position in an asset is different from a long position in a derivative. We're going to talk about a long position in a derivative in the next class. Likewise with a short position in a derivative. Don't confuse those two. If an investor has a short position in an asset, it means that the investor has borrowed the asset from someone but does not actually own the asset. As an investor, it's possible to borrow shares in a particular company from a broker, or to borrow other financial assets from a broker. So when you actually own the asset and it's yours, we say that you have a long position in the asset. But when you borrow the asset and you pay some money for borrowing that asset from another investor, we say that you have a short position because it's not actually your asset, you borrowed it, okay? So trades to purchase or sell an asset are sometimes referred to as spot trades because they occur in the spot market. Spot trades, rather than the futures trade we were looking at, you enter into the contract today, you pay the money today, and the asset is delivered today. It's not like a futures contract where you agree to purchase or sell the asset sometime in the future. And then when purchasing an asset through a broker, a trader can often borrow up to half the cost of the asset from the broker, pledging the asset as collateral. This is known as buying on margin. So sometimes if you want to purchase an asset and you don't have enough money, you can use part of your money and you can borrow half of the money to purchase the asset. So when you purchase an asset using borrowed money, partly some of your money and partly borrowed money, we say you are buying on margin. Okay, so there are regulations that stipulate that you can only borrow a maximum amount of money on margin. You can't borrow completely the 100% of the money to purchase the asset. If you're buying on margin, a certain percentage has to be your money and the other percentage has to be money that you borrow from a broker. So the asset in itself will be collateral. So if you purchase shares, you might borrow 50% of the price. Let's say the shares are worth 200,000. You might use your 100,000 and then you might borrow the 100,000. And then the share itself will be collateral. If you fail to honor your agreement, the share will be taken and sold for the broker to recover the amount. So even by buying on margin, you also have a margin account where you'll need to put a certain amount of money as the price of the share that you've bought using borrowed money moves up and down. Money will be taken out or put into your account. Okay. So in some markets, it's also possible to sell an asset you don't own. Remember, we said if you have an asset that you don't own, that you borrowed, we say that you have a short position in that asset. So some investors go a step further. Not only do they borrow assets such as shares, they borrow these assets and then they sell them. And then they hope that the price of that asset will go down after selling it. Then they can buy that asset at a lower price and return it to where they borrowed it from. It's a very interesting way to make profits from shares, right? I'll just repeat it. Let's say, for example, you borrow MTN shares worth 100,000. Let's say an MTN share is selling for 100,000 rand, right? So let's say you borrow this from a broker, right? And then let's say immediately after borrowing these shares, you sell them. And then you get 100,000 money, cash. And then let's say after a few days or after a few weeks, the price of MTN shares goes down to 80,000 Rand, right? Then you just go back in the market, you buy that share for 80,000 Rand. So you've now got 100,000 Rand and you buy it for 80,000 Rand, leaving you with 20,000 Rand as profit. And then you just return those MTN shares to the broker. They are now worth less than what they were when you originally got them, and you've made a profit of 20,000 Rand. Of course, part of this profit, maybe 2,000 Rand, will go to the interest for borrowing, which means you'll be left with 18,000 anyway. But short selling is a risky way of trying to make profits when you think that the price of a share will go down, and then you borrow that share, you sell it, you have money. Once the price goes down, you purchase that share and you return it to where you borrowed it from with interest. So we've got a simple table here, just illustrating the difference between properly purchasing shares, keeping them, and then selling them, or alternatively, purchasing shares through a short sale. This would be a long position in the shares. This is when you own the shares. And then the second example is when you borrow the shares and you sell them. And then you return the shares at the end. So let's just see the difference. Let's look at two examples and the money you could get. Let's say in April, you decide to purchase 500 shares for 120 Rand. So if we say 500, it's $420. If we say 500 times 120, it means you spend $60,000. And then let's say in May, you receive dividends on those shares worth 500. And then let's say in July, the price of the shares has gone down to 100 Rand per share, and you decide to sell them, and you receive 50,000 Rand, $50,000. If we say minus 60,000 plus 500 plus 50,000, it means you'll make a loss on the transaction of 9,500. This is if you purchase the shares, right? But alternatively, let's say you decide to short sell the shares. In other words, let's say you borrow 500 shares and then you sell them immediately for 120, and then you've got 60,000 in your bank account. And then let's say in May, the share pays dividends. Any dividends received when you borrow a share go to the original owner. So you then give $500 for these dividends to the original owner. And then let's say in July, the price of the share goes down to 100, and then you sell the shares, and then you buy the shares. Let's say the price goes down to 100, and then you buy those shares that you sold initially for 50,000, and then you return those shares. You replace the borrowed shares. You return them to whoever had loaned you the shares before. And then if we look at the money that came in and the money that came out, you will see that you have a profit of 9,500. So the illustration here is that being long on shares is bad if share prices go down, whereas being in a short position on shares is good if the share price goes down. So whenever the market is falling, you would rather conduct a short sale on the shares compared to a purchase of the shares. However, if the market is rising, the purchase of shares will give you profit, whereas the short sale of shares can lead to very, very tremendous amount of losses. Imagine if you sell these shares for 60,000 and then the price goes up to 100,000. You would be in a lot of trouble. You would end up actually having to fork out 40,000 just to be able to replace the borrowed shares. So purchase of shares is attractive if the market is going up, whereas short sale of shares is attractive if the market is going down. So analysts will always try to anticipate movements in the market and decide whether to have a long position in the shares or to have a short sale through a short position on the shares. Okay. And then lastly, for this class, we want to talk about derivative markets. We've already talked about a lot of these concepts, and we're going to touch on them some more in the following sections. The simple way to derive, to explain what a derivative instrument is just a financial instrument whose value depends or derives on from basic market values. A stock option, for example, is a derivative whose value is dependent on the price of a stock. And even looking at my example, I'm going to explain a lot about what stock options are and the different types of derivatives. But here we're simply told that a derivative is an instrument whose value depends on the value of other market variables. Another way to define a derivative is to say a derivative contract is a financial contract whose value depends on the market price or on the value of another asset. So in my example, we saw that we had a futures contract, and we saw that we could make a profit or a loss on that futures contract, right? Based on the value of what? Based on the value of maize on that assignment example. Or based on the value of what? Based on the value of potatoes. So the futures contract could give us a profit or a loss based on the market value of maize, based on the market value of potatoes, based on the market value of a stock. So you see, a derivative instrument or a derivative contract is just a financial contract whose value depends on the value of another asset. That's the best way to define it. Here they say it derives from other more basic market variables. The price of an asset is a market variable. The simple way to look at a derivative is to say it's simply a financial instrument whose value depends on the value of another asset. So we're going to look at this in the next section in detail. And derivatives, just like other assets, can be exchange traded, bought or sold on an exchange, or they can be over the counter privately between two individuals. The amount of trades in over-the-counter markets are significantly more than the amounts of trades on an exchange. Over-the-counter markets have trillions more compared to exchange-traded contracts, because over-the-counter contracts can be tailor-made to suit the needs of particular participants, and they involve large principal values. And then lastly, in interpreting these numbers, we should bear in mind that the principal value of the assets underlying the derivative transaction is not the same as its value. This is very important. The principal amount on a derivative is not the same as its value. The way we can look at the value of a derivative contract, this is sort of like the profit or the loss on the derivative contract. For example, with my example on potatoes, we saw that we could make a profit of 2 Rand, for example, or a profit of 10 Rand per kg, depending on the movements of the price. However, the principal value was 18 Rand per kg. The principal value did not change. The principal value of a derivative does not change over the life of the derivative, right? It's just the value of the assets when you enter into the contract. However, the value, the profit or loss associated with the derivative can go up or down. So the value is the profit or loss. The value of a derivative contract is not the same as the principal value. So here we're then given a simple example to end the class. It says an example of an over-the-counter contract is an agreement some time ago to buy 100 million US dollars with British pounds at a predetermined exchange rate in 1 year. So you can also enter into an agreement to purchase a currency at an agreed price sometime in the future. So the total principal amount underlying the transaction is 100 million, right? However, you might find that the actual profit when it's time, or the actual profit or loss when it's time to purchase or sell the British pounds, might only be 1 million if we calculate the value. So the profit or loss on a derivative contract is known as the value, whereas the principal amount is the value, the monetary amount that you agreed to buy or sell at the beginning of the derivative contract. So it's been a very long class. In the next class, I'll finish off chapter 5 by taking you through plain vanilla derivatives. So we'll look at all the different types of derivatives under plain vanilla derivatives. We'll also talk about non-traditional derivatives, exotic options and structured products, and risk management challenges associated with trading in financial markets and derivatives. So thank you very much for listening. That brings the class to an end. I hope it's been helpful. As usual, any questions or queries with regards to anything covered in these classes, please feel free to let me know. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you very much.